Hey guys, welcome back. If you've seen our first episode, you'll know that we've been looking at the world of crowdfunding and startups recently. And we learned a hell of a lot of things doing it. So many that we couldn't fit them all into the show. I know, it was too effing long already.
So instead of shoehorning more stuff into the main episodes, we decided to stick them into bite-sized follow-ups like this one.
So what is SEIS? Or SEIS, as I like to call it. Well, SEIS stands for Seed Enterprise Investment Scheme. In a nutshell, it's a super generous tax break scheme for investors.
But what you really want to know is, how does it work and why should you care? Basically, a startup company is able to raise £150,000 through the scheme, and anything you invest is eligible for huge relief, so long as you invest before the fund reaches that threshold. What's this relief? Well, it means you can claim most of what you invest back from the taxman.
It sounds crazy, but it's true. Let me give you an example. Say hello to Mr. Boy's trendy hair salon. She wants to expand her operation, so she's raising £70,000 on the SEIS scheme. As a proper investor should, I've checked her figures, read her business plan, and think her idea is rock solid. I'm going to get in there, because what could go wrong?
Luckily, Ross only invested £10. Anyway, he immediately gets to claim half of that back on his next income tax bill. That's right, in effect, he's only really risked £5 in this cat's crazy venture. Then, provided her companies started trading, spent 70% of the money, or, what's more likely, fails, then he can claim on the other £5 relative to the rate of tax he pays. Say he's on a 20% tax rate. You're on that if you earn less than £31,865 a year. Then you get 20% back of the remaining £5. That's only £1, but every penny counts, right?
In other words, for every £10 I invest in pussy parlours, I get £6 from the dirty old taxman.
Hey!
That's 60%. It means I'm only really risking £4 in making this asshole's dream come true. So, you've invested. How do you get the money back?
Well, if like most people you're salaried through PAYE, then all you need to do is wait until the company's traded for at least 4 months, or if not trading, until 70% of the cash raised has been spent. HMRC will then issue forms to the company directors that you can use to ask for a PAYE coding adjustment to repay the relief in equal instalments over the rest of the tax year.
And if you're self-employed like us, you can either put that into your next self-assessment, or just tell your accountant and he'll do it for you. He'll probably hate you for doing it, but whatever. Is this scheme fair though? In my opinion, no. The second half of the relief is way too geared towards big earners. Like I said, it relates to the rate of tax you pay. Let's imagine you and this other guy go crazy for an idea. You both push the boat out all the way and invest £1,000. Now, both of you gets to claim the first half off your income tax bill. But on the second half, you, paying a rate of 20% tax, only get to claim a further £100. Meanwhile, the other guy, who might be on a 45% tax rate, gets to claim another £225, which means his risk exposure is only £275 out of 1,000 to your 400. That's 27.5% of his money to your 40. That's a bit tosh, isn't it? Sure, the chances of success are the same, but the risk of losing money is far greater the lower down the wage ladder you are. Don't get me wrong, the rich investing in UK businesses is fantastic. Essential, actually. They help stimulate the economy, drive innovation, provide jobs, and generate tax revenue. And you could argue that it's better to give them these incentives, so they don't hide money overseas. But it just looks a little fishy to me. So, is it still worth being excited about?
Well, we think so. It encourages everyone to get behind the ideas they feel connected to or think are viable. And it is a good piece of legislation. It just needs a little tweaking. You might disagree, but we feel penalising someone or giving the privileged greater advantages might just be a bad idea for society as a whole. One thing's for sure, if the alternative finance world is looking for everyone to embrace it, then it needs to make sure it's democratised and incentivised for everyone. You know, equally.
That's it for now. There are some handy bullet points in the description below, and some official links you might want to check out. Again, we'd love to hear your thoughts, so get involved in the comments below and follow us on Twitter. And remember, if you liked what you see, don't forget to hit the like button, share it with your friends, and subscribe. We'll catch you next time.